In this week's video, we'll review the facts to help us answer the question, will never been higher levels of debt take down the stock market and economy? In late December 2019, the glass half full crowd will say, Amazon just reported a record-breaking holiday season. The 100% never-ending gloom and doom glass half empty crowd will say, but debt levels have never been higher. It's all fueled by credit cards. As a regular viewer of these weekly videos, you may have thought at some point that Chris and Kathy seem like really nice people, but they never seem to cover this scary chart here that shows a mountain of debt. Therefore, let's walk through some historical cases to see just how scary this chart is here. And think of it this way. This is a snapshot in time. This is data as of December 2018 from the Federal Reserve. We could have looked at a similar chart, taken a snapshot at the end of 1981, and this chart here looks just as scary as this chart here. And at the end of calendar year 1981, we basically could have said, debt has never been higher. Fast forward to the end of 1982. Scary chart, and we could have said debt has never been higher. 1983, debt has never been higher, scary chart. 1984, debt has never been higher, scary chart. 1985, debt has never been higher, scary chart. End of 1986 still looks scary. End of 1987 would have been very easy to say the bears are about to have their day in the sun. 1988 could have looked at this as a snapshot in time and easily made the case that this is scary, this is not going to end well, and debt has never been higher. If Twitter was around in 1989, we could have tweeted this chart about 4 or 5 times a year and said, this won't end well. 1990, this is unsustainable. Now remember, we started at the end of 1981. It's a decade later. Every single year, the chart has looked scary. And at the end of 1991, the chart still looks scary. End of 1992, debt is off the charts, never been higher. 1993, the song remains the same. 1994, the bull market is on the verge of a catastrophic failure. End of 1995, it's all fake, it's all created by the Fed. 1996, the economy's a mirage. At the end of 1997, we could have pulled out of the drawer, dusted off the script that we used at the end of 1981 to describe this chart. 1998, never been higher. 1999, never been higher. At the end of 1981, we could have said this is a ticking time bomb. 1982, this is not going to end well. The table shows that credit market debt increased every single year between the end of 1981 and the end of 1999. Thus, it's logical to ask, a chart like this, a snapshot in time, was that helpful relative to helping us monitor risk related to a recession and or a devastating bear market? Phrased in a simpler and more specific manner, how did the S&P 500 perform from the end of 1981 until the bull market finally peaked in March of 2000? Despite all of the scary charts and all of the gloom and doom commentary, from the end of calendar year 1981 to the peak in 2000, the S&P 500 gained 1,146%, unequivocally proving that this table, this type of commentary, and all of these scary charts that we've covered, including this one that was recently presented in a CNBC article, are not only not particularly helpful, they can be extremely harmful. This is what the stock market did between point A and point B. And here are some of the scary snapshot charts that we could have shown investors between point A and point B. Why is a chart like this and why is a statement like this not particularly helpful? To help answer that question, let's look at a very, very simple example. Let's assume that we have two households and both get hit with an unexpected $25,000 bill. Household 1 earns $25,000 per year. Household 2 earns $2.5 million per year. If you're in your 20s and you're making $25,000 a year, $25,000 in credit card debt seems overwhelming. If you're in your 50s and you're making $2.5 million a year, the same $25,000 in credit card debt can easily be handled. How do you handle it? You pull out your checkbook. You write a check for $25,000. You put it in the envelope, seal it up, put a stamp on it, and put it in the mailbox. Telling us that a scary chart like this does not give us all of the information that we need to make prudent decisions about economic and market risk and reward. If we take a look at some other and more complete data sets, we can get a clearer picture of where we stand at the end of 2019 relative to history from a risk and reward perspective. This is calendar year 1982 here, 1985 where my cursor is. This chart shows household debt service payments as a percentage of disposable personal income. And we'll walk forward from 1980 all the way to the present day to see what we can learn. What is a household debt service payment? Using a simple hypothetical example, Household A has a credit card balance, and Household A has a mortgage, and Household A has a car payment. Debt service payments are the amount of money that we basically need to remain in good standing in all three areas. Principal and interest on our mortgage, principal and interest on our car payment, and the amount of money needed to keep our credit card statement in good standing. So down here, household balance sheets are relatively healthy. They feel confident about taking on more debt, and since their balance sheets are healthy, the banks look at them and say, sure, we'll loan these people money. And then they start to lever up. Notice the slope of this line here. Things got a little bit out of hand between 1982 and 1987, and we needed to go through a healthy period of deleveraging. So we're already starting to see on the higher end of this chart is higher risk. Bad things happened in the stock market in 1987 when consumers were leveraged. Good things happened in the stock market walking forward from 1982 when their balance sheets looked a little more healthy. And good things happened walking forward from 1994. Period of deleveraging, they lever back up. Long period of deleveraging here. Confidence starts to kick back in from two perspectives. Consumers are more confident about taking on debt between 1994 and 2000, and lending institutions are more comfortable allowing them to take on more debt. Once again, we're seeing the higher end of this range equates to higher risk, and that passes the common sense test. Down here, roughly 10% of our disposable income is going to service existing debt. Up here, it's about 25% higher at 12.5%. Up here, consumers are less comfortable about taking on additional debt, and lending institutions look at them as a higher risk proposition relative to what they saw here and here. When things got a little out of hand in 1987, we had a period of deleveraging. When things got out of hand in the year 2000, we had a period of deleveraging. But in this case, it really didn't last that long. And in 2007, consumers were leveraged in a way that was riskier than this point here and riskier than this point here. And when lending institutions look at consumers here, they look a lot less attractive. So once again, we know bad things happened in the stock market in 1987. Bad things happened in the stock market in the year 2000. Bad things happened in the stock market in 2007. Good things happened in the stock market walking forward in 1982. And really good things happened in the stock market walking forward from 1994. In general, The longer the period of deleveraging and the healthier the balance sheets, the longer the economy and stock market can do well. From here, we get a 6-year move in the stock market. This is a much shorter period of deleveraging here relative to this period here. If you know your market history, the stock market's bull market on this end, the cyclical bull, doesn't really start until the spring of 2003 and it ends in October of 2007. The shorter period of deleveraging was followed by a shorter period of a run in the bull market. So after the peak, we know there was some deleveraging. Therefore, the million-dollar question as we head into year 2020, does the data that we have in hand today, the facts, has nothing to do with opinions, look more like 1987, 2000, or are we way above this level here and even riskier than we were in 2007? Which is exactly what a statement like this, debt levels have never been higher and we have a mountain of debt. This statement and this chart imply in the present day that we're up here somewhere in a very, very risky, never seen before range where really, really bad things are about to happen. And a headline like this, a statement like this, and a chart like this imply in no uncertain terms that when we walk forward from the present day, that the ability for consumers to service their existing debt and the ability of consumers to take on additional debt can in no way, shape, form, or fashion be anything even close to where we were in 1982, a favorable period, or 1994, a favorable period. Thus, what does the present day data tell us? Are we levered up in an unsustainable fashion? 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 Or have we seen a period of deleveraging where balance sheets are healthy and consumers can service their debt and they also have the ability to take on additional debt? You may find it hard to believe that this chart looks better basically than it ever has. This is all the data that we have that the Fed has collected. This ratio here is lower and more favorable today than it was at the start of the secular bull run in 1982. And this ratio, this chart, and this data set is more favorable today in 2019 relative to this point in 1994. From this point here, the S&P 500 rallied for 18 years before the secular bull ended. And from this point here, the S&P 500 saw a near unprecedented rally into the spring of 2000. Does the Federal Reserve agree with that read on this data? Yes, this is from the Federal Reserve Bank of St. Louis, October of 2019. With one exception, Q4 of 2012, total debt obligations are at the lowest they've been since these data were first collected. And this is especially true of mortgage debt. This quote here relates to this chart here, which is basically numerous ways of looking at household financial obligations as a percentage of disposable personal income, which is basically the same data that we're looking at here, a ratio. The Fed says lowest they've been. Seems to align with this chart. Can you find a point on this chart that's lower than this point here? You cannot. Therefore, it's prudent to ask, this quote from the Fed and this chart here, which tells us on a relative basis, relative to this point here, and this point here, consumers are in much, much better shape in terms of servicing their existing debt and in terms of their ability to take on additional debt. And why does taking on additional debt matter? Because that helps fuel growth. When you're a consumer here, you can lever up. You can borrow money and buy a house, borrow money and buy a car, borrow money and buy a second house. Here, the banks will give you money to do the exact same things that you were doing in 1982 walking forward. Not the case in 1987, not the case in the year 2000, and not the case in 2007. Here's another data set that tells us the present day doesn't look anything like 1987, doesn't look anything like the year 2000, and it doesn't even look anything remotely close to October of 2007. In fact, the present day looks better than two of the most favorable periods in recent history, 1982 and 1994. Thus, does all of this align with or contradict everything that we've been talking about, including the hypothesis that we're most likely in a secular trend and this was a cyclical low? And does all of this align with or contradict the demographic data that we covered in detail earlier in 2019? The answer is easy. It unequivocally aligns with all of it. So not only is debt not particularly alarming at this point, it's not a negative, it's a plus. We know what you skeptics are thinking out there. What about corporate debt? It's a ticking time bomb. We've covered this numerous times in the past, so we won't spend a lot of time on it in this week's video. If and when corporate debt becomes a problem, credit spreads absolutely positively will look nothing like they do today. Credit spreads speak to trust and confidence in the system. Up here, I'm not really sure that you're going to pay me back. Up here, I'm afraid that those high-yield bonds are about to default. I don't want any part of them. Everything that we've talked about in this week's video is based on facts that we have in hand today. Based on the facts that we have in hand today, trust and confidence is high currently in the system. I'm willing to buy a high-yield bond here because I don't believe the economy is about to go into a recession, and I don't believe that the bond I'm about to buy is going to default. That's not the case up here. I'm more concerned here, and I'm more concerned here in a big way relative to where I am today. As we've noted in the past, credit spreads can change relatively quickly. So these statements, all of them, are based on the information that we have in hand today. Another common comeback would be, but interest rates are rising. That's going to change everything. Once again, that absolutely positively may turn out to be the case, but that's not the base case. The Fed is signaling in no uncertain terms that they're basically going to keep rates where they are unless one thing happens. Inflation starts to become a serious problem. Interest rates are reflected in this data here. If rates become a problem, then this chart will not look like it does in the present day. This is massive deleveraging here. And that aligns with this quote here, August 17th, 2019. In real terms, per capita debt levels are down nearly 19% from the peak in 2008. From a third-party economist, the bottom line is that, while by no means pristine, household balance sheets are in better condition than has been the case for quite some time. And the next quote speaks to a statement like this, a headline like this, and a scary chart like this. These statements, charts, and stories are either completely wrong or wildly misleading. In reality, by almost any proper measure you can think of, household debt burdens are at the lowest in years. Household debt burdens are at the lowest in years, which speaks to the ability to service existing debt and the ability to take on additional debt. The ability to service existing debt in 1994 and the ability to take on additional debt in 1994. This is what happened after 1994. The ability to service existing debt in 1982 and the ability to take on additional debt in 1982, where my cursor is. This is what happened after 1982. The ability to service existing debt and take on additional debt is better today than it was in 1994 and 1982. Once again, driving the key point home, All of this, debt and balance sheets, align with rather than contradict all of this. Why are the millennials ready to A, service their existing debt, and B, take on additional debt? They're getting ready to enter their peak spending and earning years, the demographic sweet spot. In this video, we've made probabilistic statements about the facts that we have in hand as of Friday, December 27th, 2019. Let's talk a little bit about the future. Is debt a relevant topic and something that we should monitor with an open mind going forward? The answer is yes. Based on everything we know about economic cycles, human behavior, and stock market history, will debt become a problem in the future? The answer is a confident yes. Will default rates become a relevant topic at some point in the future? Yes. Could higher interest rates become a negative drag on the credit markets and economy? Yes. But the key takeaway is, all of that may happen, but none of it has happened yet. And the only way that we can realistically assess and identify relevant changes in the relevant data is to take it day by day with a flexible, unbiased, and open mind, and to head into next week and every week with realistic expectations about 100% normal and to be expected stock market volatility. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.